Hi, my name is David Heller. I've been a financial advisor for the last 15 years, working with clients to help them figure out ways to build their wealth, but also ways to protect it. And in today's video, I'm going to go over separately managed accounts, aka SMAs. My intention for this video is to share with you high level, this is what an SMA is, this is how it works, but it's also to share with you a lot of the use cases of where you can maybe look at your own situation and see if an SMA would apply to you. So, what I will say is, I don't usually find clients coming to us seeking out a separately managed account. I think it's just because they don't even really know it exists. But when you sit down with someone and understand what their financial goals are, what their objectives are, and even what are some of the holdings that they already have in place, because of its customization and its tax management capabilities, an SMA can be a great option in the right situation. In simple terms, an SMA is a professionally managed portfolio where the underlying holdings are owned by the investor rather than being pulled together with other investors, like with inside of a mutual fund or ETF. These accounts are customized for you, where the portfolio manager is selecting either stocks, bonds, or even other assets to meet your financial objectives. You retain full ownership of the assets, but the day to day management is up to the professional. So, meaning buying and selling, as well as rebalancing the portfolio. In summary, the key points are the customization of the portfolios, as well as the tax management capabilities. Before we go any further, let's take a step back just to understand the differences between what an SMA is comparatively to an ETF or mutual fund, which are similar investment vehicles. So at the end of the day, they're all trying to do the same thing. They're all trying to provide you with a diversified allocation within a specific asset class or sector with professional management. Now, ETFs have always historically been known as a passively managed, low cost, investment option, which is designed to replicate an index. So whether that's the S&P 500 or maybe it's the Russell 3000 if you wanted small cap exposure, maybe it's the Barclays Ag if you wanted US bond exposure. It's designed to as closely replicate an index as possible. Mutual funds are trying to do the same exact thing. However, they're adding on a layer of active management in order to outperform a specific index. SMAs, on the other hand, they're trying to do the same exact thing as a mutual fund or ETF. Again, trying to provide you with a diversified allocation within a asset class or sector. But because of their customization capabilities, it enables the investor to really hone in and be intentional in terms of what it is that they're trying to achieve with that specific investment. Let's talk about taxes, because this is an important consideration to take into account. So just like any asset, whether it's a stock, bond, ETF, mutual fund, or SMA, whenever you sell something for more than what you paid, you'll incur a capital gain. Same thing happens if you sell something for less than what you paid, you'll have a capital loss. Pretty straightforward, right? Now, with an ETF or mutual fund, since the fund actually owns the underlying holdings, not you, any dividends or interest earned will be passed on to you as a shareholder of the ETF or mutual fund. Same thing happens with inside of an SMA, because you're going to own the underlying holdings. So you'll also receive dividends and interest that you'll have to pay taxes on. So the difference becomes is that when you own an SMA and you own the underlying holdings, you can select when you want to buy, sell, or trim. You don't have to sell the entire portfolio. ETFs tend to be more tax efficient than mutual funds. Now, this is a very complicated topic, so I won't get into it. So, as a quick teaser, it really comes down to how often the underlying holdings within inside of an ETF or mutual fund are bought and sold, as well as how they redeem. But again, that's a conversation for a different day and in a different video. Now, SMAs are arguably more tax efficient than ETFs or mutual funds simply because of the transparency and the fact that you own the underlying holdings. You can, in effect, go in and decide what you want to buy or sell. So you control the tax impact versus the fund manager of an ETF or mutual fund. To help illustrate this a little bit further, let's look at a real example of an ETF or mutual fund and an SMA. So if we look at the ETF SCHV, which is a large cap value ETF, which is trying to track towards the Dow Jones US Large Cap Value Index, when we look underneath the hood, you'll see that it owns 529 different companies. And out of those 529 different companies, Berkshire Hathaway is the largest holding at 3.5%. The main difference, as we've been stating all along, between an ETF, a mutual fund, and an SMA is the direct ownership of the underlying holdings. With an ETF or mutual fund, you own shares of the fund itself, not the underlying not the underlying holdings that you see here. The fund itself owns the stocks or bonds. You just own a fractional share of the portfolio, as we were saying. But here's where the direct control and ownership come into play. So the fund managers of an ETF or mutual fund have complete discretion over what they buy and sell, which can then trigger capital gains and losses that you have no control over. Because the fund managers make the decisions for you, you can simply be incurring capital gains and losses whether you like it or not. Now let's compare and contrast. So if we look at a large cap value SMA, which is managed by BlackRock, you'll notice that it has 62 different stocks that it owns, and it lists everything out from the top holdings to what it actually owns. So just like with an ETF or mutual fund, you still might have to pay taxes on any of the dividends and interest that are earned from the underlying companies. But the big difference becomes in the control of those underlying holdings, which then basically gives you a lot greater control over your tax management capabilities versus having an ETF or mutual fund. So what I mean by that is, let's just say in a given year you had a large gain, and in order to try to offset some of those gains, you want to look for losses. This is what's called tax loss harvesting. Remember, in a given year, you can only take $3,000 of losses to use as a deduction. Anything more than that will then carry over to the next year and maybe to the next year after that, depending on how much you have in losses. So if we hypothetically say, you know what, in our portfolio, Wells Fargo, they've had some bad news again, and the stock has gotten crushed, and we don't think it's going to recover. So maybe we'll take the loss on Wells Fargo without exiting the entire portfolio in and of itself, like you would have to do if you owned an ETF, right? So like you could use the same scenario here where JP Morgan maybe had a terrible batch of news that came out and you wanted to get rid of it. Well, you can't. You'd have to sell the entire ETF in and of itself. So that's what we mean by control and flexibility, and having the ability to really be much more intentional over what you're doing and to tax loss harvest efficiently with inside of an SMA versus a mutual fund or ETF. Hopefully by now you have a good idea of what an SMA is, how it works, and how it even compares to similar investment vehicles like an ETF or mutual fund. So, just like with anything else, while there's good, there's also some things that you should be aware of. The minimum investment needed in order to open up an SMA generally starts at around $100,000 and can range as high as $1 million. This higher minimum generally will limit SMAs to higher net worth individuals only. And that's kind of how you'll see them marketed, as a higher net worth solution. A lot of this is probably attributed to the direct ownership and customization of a portfolio. The management fees for SMAs could be higher than, say, for an ETF or mutual fund. We would attribute this because of the fact that SMAs generally need more customization and personalization in terms of design of a portfolio. And the active management, of course, comes with a premium. And really, the fees are kind of subjective. The value proposition lies in what that benefit is to that specific investor. So maybe it's customization, maybe it's tax management, maybe it's direct ownership. Liquidity could also be a concern as well. So a separately managed account will have the same liquidity when investing in equities like an ETF or mutual fund. However, for SMAs holding bonds or other less liquid assets, liquidity could be a little bit more limited. Most of this you could attribute to the specific bond type and maybe the duration of those bonds. So keep that in mind. Typical use cases of an SMA could be, maybe it's a retiree who needs tax-free income. SMAs can allow for a customized municipal bond portfolio where maybe you're focusing on specific credit quality or duration. And by having that tax management capabilities and the tax-free income could help that retiree when they get to retirement in terms of controlling what tax brackets they fall in. Also, managing concentration risk with a particular stock. So this comes up in a lot of examples where we'll work with an individual who will work at a large publicly traded company, and through their compensation, they've accumulated over years lots of that publicly traded stock. An SMA can provide diversification without forcing a sale of that specific security. The investor can then build around those concentrated holdings by ultimately balancing their overall risk exposure and working around potential restrictions. And the last use case I'll talk about is really ESG and sustainable investing. So for investors that are trying to align their own investments with their personal values, SMAs will allow for high levels of customization and enabling them to exclude certain either industries or companies and maybe prioritize others like clean energy. So, this concludes our video. Hopefully, you came away with something from it. As always, check with your financial advisor, planner, CPA, whoever it is that you go to for help in order to find out if maybe an SMA could be right for you. If you have any questions or comments, feel free to reach out to us via email through our website. Please like this video because that definitely will help us, and subscribe for more upcoming content.